Hi, I'm just going to give a summary of what I've learned this week at the World Economic Forum after about 30 bilaterals with investors, policymakers, ministers, and attending various private sessions. This is the 17th year that I've been attending the World Economic Forum, and I have to admit it's probably the one that I'm going to remember the most. And the reason is because, as the minister of one of the G10 has properly said, the United States of America, the Trump administration, has filed a divorce with the political and economic order that has built since World War II. This has profound and deep macro and political implications for the years to come. What it means is de facto that every nation has to reinvest in defense, resiliency, from the point of view of energy, supply chain, food, pharmaceuticals, and all what is essential, including technology. This will have long-lasting repercussions. At the same time, the US economy is doing well and the global economy are doing well, partly because every government is spending money. So the fiscal deficit of all the major nations is high. They're all de facto printing money in a sort of way, and hence from a nominal point of view, the world is growing fast. And this means that maybe the inflation could at some point reemerge. The US strong GDP is expected to reach 5% in the coming quarter, is mainly driven by investments in artificial intelligence and data center, most importantly. Now, the investments in this area equals almost $500 billion annually. That means if you do a run rate for the next 5 years, that means about $3 trillion between now and 2030. Now, to justify an investment of $3 trillion between now and 2030, that means at least by 2030, we need to have additional revenue equal to $600 billion, almost equal to the Max 7. And I think it's unlikely that we're going to find a revenue number equal to the Max 7 by 2030, additional vis-a-vis now. And hence, I think there are some doubts in my view of what the market is currently pricing. What are global investors doing? First, they're asking themselves, how many dollars do we need and what's the weight that we should have of this US portfolio? Remember, US accounts for 30% of the global economy, super strong, but it's also 70% of prices. And hence, I think is very well and probably more than reflected. So most are increasing diversification, adding investments across the world. And this was happened also last year. And you have seen the performance of the emerging market, Europe, China, Japan, actually outperforming the S&P on a global currency basis. And that because the dollar last year has weakened by about 10% vis-a-vis global currency, and this year is expected to weaken further. There is lots of uncertainty also by the fact that this administration seems to push fundamentally every institution to reduce check and balances and basically to be fully aligned to the political will. That really creates instability, and probably, it cannot just be the only reserve currency on the planet for the simple reason that they keep on having a deficit of more than 5%. The public debt is already very high, and it appears that most of the growth so far is concentrated in the tech sector. That means it's not very widespread and could create eventually bumps along the road. Overall, we remain positive on financials because yield curve will keep on being steep. And that means that the margins in financial sector will remain positive. At the same time, they're not extended credit, thanks to the private credit industry that over the last 10 years has taken 90% of the additional risk. And that means in the next recession, they're also going to pay the price of that risk. While the major GC financial institutions around the world remain with strong balance sheet, healthy margins, and they're probably the key beneficiary of machine learning, artificial intelligence, because every CEO I've spoken to, they tell me they can start de facto firing people in back office because some of the software is already improving processes, efficiency, and accuracy. And hence, there is no Leonardo da Vinci in this AI, but there are good software to reduce back office tasks. And so overall, I think actually financials might end up being the biggest beneficiary of the early adoption on artificial intelligence. simply on mundane tasks, which will require computer and data accuracy that sometimes human beings don't have. Gold, at the same time, I think remain the number one asset class to own for the simple reason that central banks have stopped adding treasury to the reserves. Today, gold is more than 30% of central bank reserves, bigger than treasury at 25, and keeps on going up. Remember that in Bretton Woods, 1971, central banks had 50% of gold as percentage of reserves. If central banks were to go to that level, gold could reach $7,000 to $9,000 an ounce, much higher than the current level. And simply because I think central banks need to be independent in a world where the US has said everyone has to be independent, well, central bank will probably keep on buying gold because they can't buy treasury that tomorrow could be sterilized or blocked at will by the administration.